Good evening, everybody. Just another few minutes, we'll get started. Just to give everybody another couple of minutes, and then in the meantime, just for the attendees that are in here, um, you have been muted, but if you certainly have questions or comments, please use the chat functionality to access that, and we will answer those questions as we get to the end of the presentation. I'll reiterate this message as we, start in the next couple of minutes. All right. On behalf of Terra Equity Group, NERB Wealth, I, Puneet Kulhari, welcome you to this brief presentation about a new multifamily investment opportunity called SilverStar Portfolio in Orlando, Florida. I'm joined here by my team, Chief CEO and Founder Vino, and our acquisitions partner, Karan and Viraj. And today we will be discussing the opportunity we have at hand here in Orlando, Florida. Some housekeeping to start off. As a reminder, all attendees have been muted. And if you have questions, by all means, use the questions and comment feature in the webinar, and we'll answer the questions as we reach the end of the presentation. So this project, in which we will acquire at a significant discount, is a portfolio existing of two properties which were built in 1990 and 1992 in the heart of Orlando. And it's one of the very best markets in America today. Well, it's so attractive that it's almost full. We only have a very limited amount of space in this syndication, and spots are limited. It has filled up quickly for three very good reasons. The first one is ROI. This one is projected to return over 25% annualized return. So that's right, it's over 25% of annualized return on your money. And the second is the reason behind why it's so attractive to investors is it's a very familiar market with housing shortages. And the third one is an experienced team that brings a wealth of knowledge. And then those three reasons only scratch the surface of why this has been, such this opportunity has been seen as with such a great response from the investors. The only bad news I have to share with you right now is there's only limited capacity, as majority of the spots have been booked up. So time is of the essence. We do have a great existing investor base, and a lot of them have shown interest in this. So uh, they have taken the opportunity to, take upon this presentation. I mean, take upon this opportunity to sign up for the project. As you see, the clear opportunity presented by the SilverStar portfolio is very profound. And in this particular market, as we see in Florida, being one of the top markets in Orlando, again, is a very up and coming market where the potential is unlimited. A little bit about me. I have a doctorate in pharmacy, and I've been involved in real estate for the past 18 years. Got involved in the multifamily space for the past 7 years. Since then, I've been part of 14 syndications, and this one will be making 15th as we speak. So now,
Maybe you're muted.
No, we can't hear you, Sanivia. We can't hear you.
we can't hear you. I apologize. So I'm not sure where I got lost. Hold on one second. All right. So disclaimer. All right. As I was saying, first, let's make the lawyers happy. This information is for educational purposes only. Results cited here are past performances and may not reflect the future results. Do not I'm sorry, guys. We're having some issues where this mic keeps muting me out, so I'm not sure. Can my team hear me?
Yeah.
I'm not sure why it keeps muting. I apologize for that. Again, let me start again. The disclaimer, let's make the lawyers happy. This information is for educational purposes only. Results cited are past performances and may not reflect future results. All right. Do not deploy your capital without fully understanding the risks, which are substantial in real estate investing. You could lose all of your investment or more. Always consult with an independent financial and legal advisor before pursuing opportunities such as these discussed herein. The best rule overall is just be smart with your money, right? About investing, always respect your own capital. Don't make any rash decisions. Get to know the people behind your investment opportunities and their track records before making any decisions. Okay, now that we have made the lawyers happy, we'll move on and discuss the first topic at hand. And let me try this again before the mic. So hold on one second. I'm going to give me a minute. Let's try this again. Nope. Give me a minute.
Muted.
All right, I apologize. Give me a minute. All right, so 3 agenda items here for a brief time together. First, why multifamily? The second one is to get really specific and answer why does SilverStar portfolio check all of the 3 boxes that a prudent investor are looking to get above average returns, right? Finally, we'll wrap up with a word of qualifications and how to participate in the offering that we have right here in front of you. So now I will transition this over to Raj, and who'll take it over here from there. Hold on one second. Let me just make sure. I apologize for the.
Hey guys, so we're going to be talking all about why you want to invest in multifamily. So today I'm going to give you 5 of the many reasons to choose multifamily as your next investment. The first one is passive income. Now I know a lot of you might be landlords already and you might be thinking it doesn't seem very passive when I'm receiving calls at 2 a.m. about a broken pipe or a call in the middle of winter about a broken furnace. No, but in a syndication it's different. When you're a passive investor in a syndication, you don't deal directly with the hassles of day-to-day management of the property. They generate cash flows for the investors, just like you from day one, and that generates a cash flow check deposited into your account each and every month. And have you been listening to the news in regards to inflation? I'm sure you've all heard something or the other about it. Well, if so, reason 2 will be of particular interest to you. Multifamily investing is a fantastic hedge against inflation. As we all know, the dollar is not worth the same as it was in 2020. We've seen this time and time again as everything goes up, right? The prices of gas is increasing, groceries, rent. So multifamily investment really helps you combat that. Reason number 3 is extraordinary tax benefits. Unique among virtually all asset classes, real estate offers something very, very powerful. Serious tax benefits. And not just financial gain from income and equity, but financial savings by reducing your tax income each and every year, particularly in year 1. For most people, and of course, you'll need to discuss it with your own tax advisor, real estate is a wildly favorable tax benefit every single year, as long as you're participating in any multifamily deal. The IRS allows multifamily investors to write off a percentage of the value of the building each year as an expense through depreciation. I won't get into the specifics of depreciation exactly, but I will excite you by telling this. Multifamily real estate is absolutely astoundingly powerful when it comes to generating tax benefits through depreciation. You don't have to understand it, but your tax advisor absolutely does, and it can make a huge impact on your taxes every year, especially year number 1. Now, you might be thinking that you don't necessarily need a big tax break this year. Not a problem at all. You can carry forward your tax benefits to future years indefinitely, and every tax advisor knows this as well. This isn't new. It's not something that's operating in the gray area of tax law. This is well documented and uncontroversial and a highly reliable tax strategy in which you can have absolutely extraordinary confidence. Every single high net worth individual looks to find some way to save taxes, and real estate is the best way to do so. It's so good that for some people, you might even be able to take a deduction against your entire investment amount in year 1. And your stocks aren't going to be doing that for you. The 4th reason is that it's recession resistant. Perhaps one of the greatest advantages of investing in multifamily real estate lies in its extremely low risk profile. For decades, the multifamily market has proved much less volatile than residential real estate, the stock market, and also most recently, cryptocurrency. Well, what about COVID and those eviction moratoriums? That's why it's important to pick a team that knows the market. The product has a proven track record of success, which I'll go into later, but our rent collections never dropped below 94% collections all throughout COVID. But more importantly, our investors never missed a monthly cash flow check from us during the pandemic. The last reason is simply amazing returns. This is going to be my 6th or 7th investment while working with Vino and the team, and we've constantly returned our investors returns of over 20%, period, which is hands down why our investors invest with us multiple times, because they're so happy with the result. Go to the next slide. So now we're going to zero in on specific market cycles and ride the wave up as depicted in this diagram. So there's 4 market cycles. The first is when there's a buyer's market. And this is your typical buyer's market. The vacancies are increasing, the rent growth is declining, there's new construction that's not being absorbed just as quickly. Second is that buyer's market for distressed assets. This is when there's no new construction really going on. Vacancies are increasing, there's a lot more supply than there is demand, and there's negative rent growth. The third is the seller's market. It's when everybody wants to buy and invest. There's negative or flat rent growth. There's a strong increase in employment, and the sellers are positioned to sell themselves for great value add plays. And the second is the second seller's market, which is where sellers are actively looking to exit their investment. There's declining vacancy rates, rent increases are driven by renovations and constructions, there's a decline in unemployment. So what essentially happens is that multifamily real estate investors have the ability to leverage both buy and sell cycles to maximize their returns for their investors. And the best part is that because it's a cycle, it's always going to be the opportune time to exit and enter an investment, as long as you time things right. So now we're going to go into a sample market. So for example, we typically like to invest in the southeastern United States, primarily the Florida market. But we're going to leverage into the south. Most of the time we like to do landlord-friendly states. And here are some key characteristics of what we target. We like to look for places with job growth. So Florida, Texas are the top 10 states where there's job growth. We like to look for places that have been notoriously known for being the best places to live. So for example, Austin is a city that's been the number 3 city in the entire United States. We want a place that has a high percent of renters. We want to make sure that the individuals especially the complexes that we're investing in have the ability to maintain the level of occupancy that they have, if not increase it. That level of occupancy won't be there in a place where there's majority residential homes, things like that. So that's why we like to look for places where there's a lot of renters. We also like to look for what's considered a hot real estate market. As I'm sure all of you have heard, Florida right now is booming. Everywhere you look, people are trying to buy up properties left and right. And then we also like to look for key drivers for multifamily growth. We like to see whether or not there's new construction being brought up, whether or not people are investing in that place, whether or not there's new companies moving in, things like that. Additionally, high migration. As I'm sure everyone's been hearing through the news as well, people are moving down to Florida, people are moving to Texas. Those are places with high migration. And then the third, or the 7th actually, is that it's attractive to businesses. You want to make sure that the cities, the states, they're all investing in the growth of the area. So that includes tax cuts for different companies, incentives for big companies to move their headquarters, things like that. We already touched on the high population growth, but then another important factor is the young population growth, because the majority of young individuals are renters. So you want to make sure that you have that database as well. Now, before I delve into the specifics, I do want to introduce our team, because at the end of the day, if you don't have a team with a proven track record of success, you really don't have much, regardless of how good the opportunity may or may not be. So just a little bit about us. So we believe in creating long-term relationships, be it with brokers, sellers, or investors, and we believe in creating generational wealth with capital preservation being at the cornerstone. We have excellent relationships with our brokers. They're the ones that provide us, off-market deals with the best incentives, and we have catered that via our track record of success. Our values are family, passion, and legacy. This slide over here goes really in depth about what we truly want to encompass at Terra Equity Group. We treat our investors, we treat our tenants, we treat our communities all as a part of our family. We're a family-owned and operated business, so we like to make sure that we reflect that with everything that we deal with. The second is passion. We're all extremely passionate about real estate here and making sure that we're preserving the capital. And the third is legacy. We want to make sure that all of our investors can leave a legacy for the long term. And that's through our initial value system over there and the sustainable communities that we can build. The next slide is going to talk about Terra Equity Group and ERBE Wealth. So Puneet has already told you a little bit about himself and his experience, but I wanted to introduce you to Vino Kalari, who's our partner and operator extraordinaire in around 14 different syndications. He has all the formal qualifications, a master's degree in accounting, an MBA in finance, and an impressive professional background in which he spent years working as a CFO for the Florida Department of Transportation, where he oversaw a $400 million transportation budget. But specifically, where real estate is concerned, in his nearly 30 years of experience, he has bought and owned millions of square feet of commercial real estate. He's had over 3,500 multifamily units under management, spanning from Florida to Texas to Kentucky to Georgia, and nearly a dozen total states in between. He has performed over, but more importantly, successfully run 37 different real estate syndications, where he's operated the properties to pay out consistent annualized greater than 20% returns. One thing that I can say that our investors love about him is that he doesn't lose money. He's very much a proponent of the Warren Buffett school of thought on risk. So rule number one is never lose money. And rule number two, never forget rule number one. Even during the incredibly turbulent times of 2007 to 2009, and more recently during COVID 2020 and 2021, his investors never took a hit and they never took a loss. When markets become volatile like they were then, and like they certainly will be again in the future, you'll love his careful, measured philosophy even more. The key is that he's incredibly careful, considering 100 or more deals before picking any one of them to actually perform. Now, I'd also like to introduce you a little bit about Stephanie Walter. She's the CEO of ERBE Wealth. She's a capital raiser and a syndicator, recently retired and sold her insurance agency of 16 years by following the key principles that she learned from wealthy investors that she's worked with over the years. She's been featured on various podcasts and webinars, and also has an ebook, The Business Owner's Guide to Generate Passive Income. Before we get into the specifics of this particular offering, I do want to talk about a little bit of our past recent and hit wins. So there's a reason why our investors continue to invest with us time and time again. They get access to an elite set of opportunities that provide excellent returns with no hands-on management. Just to give you an idea, just recently we closed on a 45 mixed-use asset in Orlando, as well as a 76 unit value add play. These are just recent acquisitions. But if you look at the ones that we've closed on upon last year, we're already projected to have 24% to 29% annualized returns on them. And this is, something that we're grateful where Vino is in the driver's or operator's seat, as we call it, because he has a proven performance of running these projects at peak capacity. And he's proven it time and time again, as evidenced by some of these more recent wins. So as you can see on the slide, these past investments have performed outstandingly. Now we can get into the specifics of this one.
So let's move on to agenda item number 2. Why SilverStar portfolio? And as cliche as it sounds, location, location, location characterizes this acquisition very appropriately. So in the interest of time, let's look at a few of the specifics of this project that I can tell, and then we can talk about how you can qualify to participate. Okay, Mirage, that's great. But what market is this property in, and do you have any experience in it? Well, I'm very happy to say this property is located in our favorite state, the great state of Florida. In April 2021, U.S. Census Bureau figures showed Florida gained more than 2.7 million residents since the last census in 2010, boosting its population to 21.5 million as of April 2020, up nearly 14.6% from 18.8 nearly a decade ago. It's the nation's third most populous state behind California and Texas. Now let's get into the specifics. We can all agree that you just need to open a newspaper or watch your local news station to find out the mass migration that's happening into Florida. And as a result of that, there's a massive housing crisis in the state. Our market, Orlando, Florida, is a very desirable place to be. Third most competitive U.S. location for business, top 10 best city for college graduates, 5th US city most Americans are moving to, and also friendliest Florida city for small businesses. Top 10 city in the US to outpace the nation in job growth. And it has major international companies such as Walt Disney, Lockheed Martin, Siemens Energy, Mitsubishi, just to name a few. It's a top location for entrepreneurs, strong talent pipeline with more than 1.2 million in its labor pool, great environment for business with no personal income tax, offers business-friendly environment, unbeatable quality of life, favorable weather, and abundance of recreational activities, arts, fashion, music, and sports. It is consistently listed as one of the top cities in Florida for population growth, job growth, and low unemployment. This is the perfect state at the perfect right time as the migration into Florida and the Sunshine State will just continue to accelerate. That's a major trend we're taking advantage of, and that's why our management team, along with individual investors, have been so eager to get involved. Now, a little bit about Orlando. There's a 250,000 population in a 5-mile radius. The median age is 33, which, like my cousin had initially stated, that young people are renting, so it's for our benefit. 87,000 households in the 5-mile radius as well. Downtown Orlando, largest urban center in Central Florida, 1,100 businesses with over 1.75 million square feet of retail and entertainment space. Walt Disney World, which needs no introduction, but it's the 4 main theme parks with 30,000 acres and employs over 74,000 employees. Universal Studios has over 7 resort hotels, and it's undergoing construction on a brand new 750-acre theme park called Universal's Epic Universe. Orange County Convention Center going through a $605 million expansion, adding over 340,000 square feet, including a concert venue capable of holding 20,000 people, the nation's second largest facility. You also have University of Central Florida, 70,000 students, houses 13 colleges, offers 148 programs, which includes bachelor's, master's, doctors, and various other opportunities. You also have Advent Health, a 1,700-bed hospital specializing in cancer care, cardiovascular, digestive robotics, and innovation and spine care. As far as the investment opportunity goes, SilverStar portfolio consists of 2 beautiful properties. Highgate, which is 320 units, built in 1990, and Collington, which is 216 units, built in 1992. The construction is top quality and should be noted that the construction is concrete block construction. This type of construction is preferred more and more in Florida to weather hurricanes and is largely resistant to mold. And I'm going to pass this on to our CEO, Vino.
Hey guys, thank you so much. Next one is executive summary. This talks about 2 properties that they spoke about. Viraj and Karan, they spoke. Total cost of purchase is $107 million. Our partners will share 65% of ownership, and total capital raise is $11.8 million. Minimum investment is $100,000, like you can see on our pitch deck. Estimated holding time 3 to 5 years. The park at Highgate in Collington is a 536 unit value add portfolio and one of the most profitable markets that you guys have heard from our team. These are desirable locations, and unfortunately, it is significantly boosting value by rehabbing majority of the units. Another two big factors on this one. One, we live and we know the market. We have been here in Florida for the last 35 years, investing in Florida, and we know inside and outside about the market. Second thing is we have an awesome team, so we have great boots on the ground where they perform well above like any other place. Like is reachable, they are down there and they can really get the things done. The next slide is the property overview. They already spoke about it. 320 unit and 216 built in 1990 and 1992. Why this is important? Because we will the property management is in place along with all the contractors, and can take over and run this in a very efficient manner and quickly. These are close to each other in proximity. They are less than 0.7 mile away from each other, so it's going to be really management easy, and we can really save time and money with the management, with employees, and maintenance crews, and also scaling with the construction crews. On what's our plan with these properties are the first, increasing the rent to the market. These properties were not performing to the market level, so we're already increasing. While we're in the contract, we have directed our team to increase by $200 on each unit basis. The second stage is, lease out all the things, make it to the market, and then start, creating, rehab plans that we immediately will start doing the rehabbing on the exterior portion of it, and then we'll start with the interior. Our rehab plan is quick, fast, and we're expecting to make it finish in 24 to 30 months time frame, all the 536 units. Next slide. So now let's get on to some financial summaries that really makes this opportunity very exciting. So one of our best practices, we are very conservative when we underwriting these deals. Like you can see, I mean, we have expenses that they're, 2%, we are increasing even though market is changing. So when we underwrote this thing, we were doing 2%, and rent increase is 5%. Right now, we're increasing close to 25%. We have two other properties in Orlando where we're increasing the rent by 25%, and the cost has, basically shown us the next 5 years we will be increasing, the rent will be increasing in Orlando market in double digit, but still we're underwriting with a 5% rent increase. Second thing we're doing it, like one line item comes to my mind because we just recently got the insurance quotes. We have projected when we were underwriting $589,000 for both the properties. Right now, quote just came at $300,000. So we're already saving almost $289,000 on the insurance quote that we estimated high side of it. So when our underwriting goes is very, very conservative, so our investors can always expect we perform better. Also, the cash on cash, these property, we expecting them to be well performed on a cash on cash. We are offering here or projecting that first year alone we will be projecting 10% cash on cash, second year 12, 14, 16, and 18 combined average sort of 5 years. We're expecting about 14% cash on cash return on these projects. Our preferred return, it starts with a 7% depending on the investment and goes up to 8%. So that's basically you get year after year until we sell the property. And if we have, like we show the cash flow return will go high. And the second slide that shows that we have 2 bedrooms, 3 bedroom, 1 bedroom, and two bedroom. This already shows that what our existing rent is as we're taking over the property and what's the market renting. We have directed our people to start increasing the rent as the units comes available. So you can clearly see without doing anything to these renovations or anything, we are almost $200, some cases $150, or in some cases $100 below the market. Once we do the rehab and analyze, there will be almost $400 on each unit. Plus, existing owner, they're not charging for washer and dry. Our business plan also speak about immediately increase by $75 per unit. All units equipped with a washer and dryer, and they have a washer and dryer in there. So we're expecting the value to increase substantially. Next slide. It talks about, again, we're raising $11.8 million cash on cash return that you have seen on the previous slide. That comes out to close to 73% annual, in 5 years time frame. And then at the sale, we are realizing 28% annual growth. So total, we're projecting at 20.764. And I can tell you based on our past experience, we're going to way past this thing. It's not guaranteed, but last 37 different syndications that I've been involved in, we always have outperformed anything that what we have, put it out in our projections. we also projecting very conservatively that, if situation changes, we forecast our sell prices. And we started with the 4% because looking at the market and looking at the sales cycle between 3 to 5 years, we were, very close to 4 and 4.5. That's what as is exists. But based on our conservative underwritings, we say, okay, worst case scenario, if we do sell it and it's a 5 cap, then what's our projected? So we are, projecting based on 5% cap rate when we're selling or exiting the project.
Now, let's jump into the third and final agenda item for today, which is the question of how do I qualify to participate? Well, the answer is very simple. There's three things. First, we want to make sure you're an accredited investor. And if you have questions regarding as to if you qualify to be that, we can certainly answer that offline or towards the end when we answer the question. Secondly is if you're going to be a good fit, if we're going to be working together as a team, it's imperative that we both, the investor and us, we get a good understanding of where you're coming from, what your needs are, and if we be able to meet each other's goals. And so the idea is if we're going to be working together for the next couple of years, we want to make sure we're both a good fit for each other. So that's another requirement that will qualify you based on the conversations we have and based on the needs that you have. And then lastly is the opportunity, which I had mentioned to you earlier, where we have a limited amount of spots remaining here. So you may ask why the limited availability. Well, that's because even though the raise for this project, the total raise is close to $11 million, the fact is we have filled majority of the spots without going outside of our past and current investors. So very limited number of the spots remain, and that's why we are hosting this webinar to answer and address any questions you may have. And if this does pique an interest, I would urge you to make a move and do not delay, as time is of the essence. And please take the opportunity to visit the URL I will present at the end of the presentation, where you can reserve your spot. So now we're going to jump into some of the frequently asked questions. We did have some questions that came up as the webinar was going on. We would kind of, in the interest of addressing it with everybody, we will read those out and answer those questions. So maybe multiple people had the similar questions, so that way we can be efficient with time. First and foremost, the FAQ section, you can also be found in the pitch deck, but a lot of the common questions are here addressed, which we can go through. And typically, if you've been part of a syndication in the past, they are very much similar. So they're here for you in the interest of time. This is accessible again as part of the pitch deck, so I do not want to belabor the point and bore you guys with this. So we do commonly get also what's the minimum investment amount. So our minimum investment is $100,000 per investor. With that being said, we do have opportunities for investors who do want to bring in an additional amount or more than 250K. We do something special for them. So we'd love to, chat with you offline if that you fall into that particular bracket. But the minimum for this current project is 100K to get involved in. Here are some of the FAQs that we typically have. When you need the money, it's a first come first serve basis, as I've alluded to earlier. And what's your exposure to risk? Your exposure to risk is minimum in terms of what you're investing, right? Liability from that aspect, you're immune. You're a passive investor. You're not involved in the day-to-day activities. So you're in a limited partner with a high upside. All right. Now we can certainly, the second section of FAQs, and then I will take this opportunity to present you with the URL that would be that you can click on and reserve your spot. If you do have individual questions that you don't want to address here, we certainly have, a phone number there. You can reach us via email, and we're readily accessible. But I do want to take an opportunity, and I do want to close with this. This is a very special opportunity with strong profits, monthly cash flow paid throughout the holding period. It's a great construction, which is concrete block construction, as said earlier, and we're buying it at a very discount rate. Our acquisition of this is going to be close to 200,000. That is inclusive all purchase and acquisition costs, where the current comps are trading over $250,000 a door. So we're already in a great cost basis going into the property. All right. Along with the fact that we have an experienced management team, we live in the market, we know what's happening there. We know how the comps are going. We know how the market is moving and what we need to do. And we're typically in our assets and portfolio, we're the market leader. So we set the trend when it comes to rents and what have you. And we take pride in what we do, and that, in essence, creates great returns for investors such as yourself. I mean, projects like this don't come very often, and that is why, in fact, a big chunk of the raise that we are having for this particular project has already been spoken for. Well, it's about time to wrap up. Again, I appreciate everybody taking their time. I do want to reiterate the portal and the URL that you would use to reserve your spot. At this moment, we will take an opportunity to unmute everybody. There are questions that were asked before. We will address those questions. And if you would just give me a moment to do that. Hold on one second.
I think one question that we failed to answer is when it's closing. It's closing on May 20th. So, we just...
Okay. So we have a little bit less than 3 weeks left. So if you are interested and you are serious, then I would certainly urge you to go on the portal.terraequitygroup.com to reserve your spot right now, as space is extremely limited. And I will now unmute. Give me 1 second. All right, perfect. So I'm going to address some of the questions that were asked by the investors as we were doing the presentation, and this is to benefit everybody else who is on the webinar. First question that was brought to our attention was, what kind of how much discount are we getting, right? So while the purchase price for the property is $91 million, which puts the 536 units at a cost of $169,000 a door, but our acquisition cost, including rehab and everything, makes the whole transaction at about $107 million, which brings up the cost of each unit to about $200,000. As I alluded to earlier, the current comps are trading above $250,000 a door for similar vintage properties in the area or in the Orlando market. There is currently another one that is being offered. It's a 100-unit smaller portfolio, and which is the asking. That's what the broker saying the whisper price is, at least $250, and that's not to say when they have called for offers how much higher that property is going to trade at. So.
Well, plus I wanted to add that, you're talking 200 after the property is completely rehabbed, as is properties are selling 250 and we are buying for 169. So that's wow. The, delta.
Great. Yeah, the 200 I quoted was, again, with the acquisition costs, which included the rehab, which we'll be doing to bring it up to, And Vino just said the delta is, almost, greater than even the 50K right now based on what we're acquiring the property. Again, this is an off-market deal that we're getting at a great basis through a brokerage relationship we have had. Second question was regarding contractors. Do we have, with the shortage and inflation, would that affect a rehab plan? Vino, do you want to answer that question?
Well, of course, the market would a little bit, affect, but we've been dealing with these contracts so long, so they give us a first priority, and we buy in bulk. So, we're not, doing all the 536 units at the same time. We will be doing, 10 or 15 units every month. So we will have a storage facility over there. We will buy in bulk. We will buy in advance. So as soon as we close, the lag time is like close to 30 to 45 days before we get all the stuff in. But we go based on, because remember, these are cash flowing properties. We will not evict everybody and try to rehab them. We only start increasing the rent, start adding the value. And if some people, they cannot live in there because we are increasing $200, and if the unit comes available, then we're going to start rehabbing. So we're projecting at least between 10 to 15 every month. So we don't foresee anything, but then again, it totally depends on what markets holds in the future, how they do it. But we have similar projects going on in Tallahassee, and we are not seeing any delay, on the other one. So, we should be very comfortable about, going in with this.
And then Vino, the question, there was another question regarding the sensitivity analysis and regarding the exit cap. I know we've been very conservative in our underwriting, and we're anticipating, and our projections are based on exiting at a 5 cap, correct? And,
yes.
And right now the market is trending on the, close to 4 or even, mid 3s or high 3s. So I think that just bodes well for our investors and how this whole transaction is going to turn out at the end.
Well, we expecting the 5 is the worst case scenario. Remember, we put all those measures in there. So even though the cap rate may go up, but we also increasing 25% on the rent. So that's going to give us an upside. So it is, cap is again based on the NOI that we're producing. So we start producing higher NOI. That NOI was based on 5% increase. But if this year we're doing 25%, next year we're doing 10, or then 7 or 8, our NOI is going to be very high. And if the cap rate a little bit maybe goes 5.5, but we'll still, able to produce the 25 or above 25% return on these properties. We also getting, our loan amount, it's unheard. Everybody probably want to think about it, but our, highest loan from the bank is 2%, and we also cap that with the cap lock. So, we have that 2 and 1% for next 5 years. So most of the loans right now is there either 3.5, 4, or maybe they're trickling high. But because we have a built-in relationship and existing relationship and long-term relationship, the lenders feel comfortable with us. So even our interest is 2.1% on this project.
Perfect. At this time, I want to just give a last opportunity to any questions. Do any of the attendees have any other questions that we can entertain? We'll wait for another minute or so. If not, then we'll kind of end the session here. Certainly, I would urge you again, as I mentioned, time is of the essence. We are getting a lot of traction on this project and this property, as it's a very desirable market with an experienced team that has a proven track record, and the part of market cycle that we're in, as Karan alluded to earlier, and we're, I think, going to be in a very good spot and position with this particular transaction as the year and Florida gains in popularity. We have masses of people moving in, corporations are coming down, relocating from states like New York and what have you in California. So this only bodes well for us and a bright future for our properties here in Florida, and we're anxiously looking forward to the returns and how we can surpass the projections that we have projected here. So I believe we have another question that just popped up real quick. So the cash flow, I think this is a question, maybe you can ask. The cash flow is 65-35 split. Yes, that is correct. The 65-35 split with a preferred return. Correct, Vino?
Yes, we like to make it very simple. So everything is like, we don't have different hurdles. We wanted to make sure our investor enjoy the same thing. I have seen different syndicators, they, have a waterfall on different stages, like they create 5 or 10 different stages. If you earn this much and this much. So for us, all our syndications are straightforward, 35-65. So if we increase value so high, they still get a 65%. There's no hurdle. Even the cash flow is 35-65 split in the middle.
Perfect. So another minute or two, we'll hang in there, and then I think I want to thank everybody here, our panelists, for taking the time and talking about this opportunity. And we're certainly accessible via the contact methods that you see on your screen now, which is the portal is the best way to kind of go in and reserve your spot. Certainly the telephone number there, you can reach out to us or email us. That is also available to you and at your disposal. All right, so we have another question. Give me 1 second. Okay, what is the GP capital contribution, if any? Vino, you want to answer that? Where do we come in?
Sure. In this deal, GP is going to put approximately 20% of the range.
So out of the 11 million, we're responsible for the 20%, correct?
Yes, we're bringing in 20%. Yes.
Absolutely. Perfect.
And not only that, I wanted to add to make our investors feel comfortable. The loan that we got so low, I'm personally liable. So most of the loan is non-recourse loan. This one is 25% is recourse loan. So, I'm on the line for the loan. Just want to make sure that how comfortable we feel about this, investment and how committed we are. So we just don't, run away and say, okay, it's not working out, thank you so much, but we will be responsible, and this is a 25% worth of loan is recourse loan. That means it's guaranteed by me.
Very well said. But we have more than our skin in the game.
Yes.
Perfect. We'll hang on for another minute or so in case anybody thinks of any other questions, and then we'll end our presentation here. I want to take a moment and thank everybody for joining us and giving us the opportunity to talk about this project that we have in the works. We're very excited about it. And so are a lot of the investors who already signed up. So if this is something that piques your interest, I would urge you to make the move and make your commitment. Log on to the portal and go from there, as time is of the essence, and it is going to get a ton of traction after the webinar as well. So, as we did have a high amount of attendees for this webinar. All right, with that, I think we do not have any other questions. I will end the webinar, and I thank everybody for joining us, and I want to thank the panelists as well for taking their time to discuss the opportunity. All right, everybody have a great evening and a very happy Mother's Day weekend ahead of you.
Thank you,
Thank you,
everybody.
guys. Appreciate it.